It's been an incredible conference, so thank you for the speakers and panelists that have participated. As noted on the last panel, my name is Clements. I'm the Director of Advanced Research and Knowledge Management at the Alberta Securities Commission. I'm honored to be able to moderate our final panel on technology in the capital markets. And so I'm going to have the panelists introduce themselves, and then I'll mention what our objective of this final panel is. So go ahead, Jean-Christophe.
All right. So I'm Jean-Christophe Boucher. I'm an associate professor at the School of Public Policy downtown. My area of expertise is actually AI, machine learning, and national defense. So most of my work and most of the funding I have is working with global affairs, national defense, and NATO to track down Russian, Chinese, and far-right disinformation in Canada, and building AI tools to actually allow governments to do this properly. That's what I do.
Perfect. I'm Mark Dain. I run partnerships at Neo Financial. We're a fintech based in Calgary. We're actually the fastest growing Canadian unicorn of all time, and we're focused on providing core financial products and services to Canadians. I did want to mention we're hiring for a bunch of different roles across tech, marketing, a lot of those core banking functions. We do want to build this in Calgary. We want to build this in Alberta. And I know a lot of people come to these things to look for new career opportunities. So certainly just, don't look at the people at your table, but certainly reach out after the fact. And my background prior to that, most of my career in investment banking, largely cross-border. I also write for Forbes in the finance and energy section, if we want to get into those topics in the questions. And then also ran the Calgary office for an enterprise AI company focused on energy efficiency.
Great. So my objective today with this panel, we're going to be touching on several themes that have come up, and we're going to try to take those a little bit deeper. So I effectively have three objectives. Number one, I want to discuss some of the benefits of data, of new technology, of financial innovation within finance and capital markets. So how are new technologies valuable, and how can they be used to lower the cost of financial services and capital markets engagement by investors? Second, I want to contrast then with the risks, and we've already touched on a few of these already in some of the panels. So I want to get in a little bit about what are some risks and try to understand a little bit more about how these risks may materialize in a capital markets context. And finally, I want to direct some discussion around what are some things that we can think about for the future? What are some future trends, and how can these future trends help us to inform intelligent regulatory the design of intelligent and responsive regulatory frameworks? Now, before we jump into those questions or these themes, I'll note that we do have the question function, and we welcome questions. We'll try to reserve a little bit of time for questions at the end. Like all panels, in the event that we can't get to all questions, a staff member, if you leave your contact information, will respond back to those questions. So before we jump into the panelist conversations, we thought it would be interesting to engage the audience a little bit. We haven't done this quite yet, other than the way you're responding to questions, but we wanted to have two back-to-back polls. So if you can cue the first poll, if you'll take a moment and use the QR code and respond to the poll. So first poll, what innovation, in your opinion, represents the greatest opportunity for capital markets? So let's focus on the benefit here. So we'll give a moment for that to materialize. Now, we don't know how many respondents we have, so that might be 100% of one. So I know that the data analysts on my team are probably thinking that to themselves right now as we speak. So we'll give a moment for there, or perhaps everyone is aligned. We'll give that a moment. Now. Anticipation on the refresh.
It's like a horse race.
Yeah, it is. So maybe give like 5 more seconds on this one. So unlikely that artificial intelligence will be overtaken in the remaining 1 second. So let's now go to the second poll, which identifies the same technology but asks a different question. What innovation poses the greatest threat to capital markets? Interesting which one we saw zoom up very fast. We'll give that a moment. In the event the result is the same, that actually feeds well into kind of the theme of what we want to talk about, is we don't see it as an either-or proposition. We see benefits and we see risks, and we want to design regulatory frameworks that are intelligent and responsive to foster benefits and innovation, but to guard and mitigate against those risks. So it looks like we probably have a firm winner on both indications. So let's start now. As kind of a lead-in to artificial intelligence, we have to think about, well, what informs artificial intelligence? The term artificial intelligence means a variety of things. You'll hear it in the media, but usually we distill it down into particular technologies like machine learning and deep learning. And really what informs these models is data. So I want to first talk about data. So let's throw a question out to both of you. We hear all the time about the importance of data as a, quote, extractive resource in fostering innovation. So what do we need to understand about data and its importance to the new economy?
Yeah, I think Canada's at an intersection right now where there is a lot of friction around data and financial services. It's pretty interesting where Canadians actually pay the highest fees for core banking products in the developed world, which is kind of wild when you think about it. We're already in a cost of living crisis, and there isn't an outcry for the price people pay for financial products. And the interesting thing is that most of the extra costs in financial services are due to data asymmetry. So there's the traditional one where, okay, you could be the best borrower in the entire world, but if I don't know that, you're probably not going to get a great rate. Or, you know, if you want to use all my products, but that's not clear for me, I am not going to price in that eventual cross-sell into the product I want to provide you. And I'd say the extreme of that is there are a lot of people that are overpaying for legacy products, but in Canada, we make it very difficult to target those individuals. I think the exciting thing is that a lot of countries have solved this with open banking, but there isn't really the willingness here, or at least the urgency, to make that data accessible. And I think, to be fair to consumers, they don't really know what open banking means, so it's difficult for them to get super supportive over the policies. And I think the large stakeholders think about their portfolios defensively rather than aggressively, so they haven't been supportive of it either to date.
When I think about data, I think as data, like we're an energy town, and we're a province that actually really feeds off, you know, natural resources, and you have to start to think about data the same way. And in most cases, I'd say, like when we talk about AI, and even social media platforms, what is valuable about that is not the technology, not the deep learning, not the super fancy engineer features that they have. What's really valuable in this is all the data that it collects all across our society, in government, at the city of Calgary, the province of Alberta, the government of Canada, all these social media platforms, all these banks are collecting vast amount of data, and it's everywhere, and it's pervasive, and it's not well used and not well extracted. Companies that are valuable are those who actually can have good data, curated data, knows how to do it, and how to sell it. And what I think about this is that right now we're still in a kind of environment where we think that data is kind of free, should be free. You know, I should have access to all of those. And companies that have the capacity to collect good data, have a good sense of how that feeds into a data pipeline up to data visualizations, will be able to really extract a lot of quality information, decision-making, and value out of everything. And once we start to think about this as our society, as this centric notion of datafication of our society, then you start to think about data as an industry in itself, where you would have a company that just does that, collects that, curates it. What I find when I work with partners across NATO, Government of Canada, City of Calgary, everywhere, the university, even my university, We have data sets everywhere. In the bad formats, a lot of them are terrible. The data stewards actually can't find them. They're on hardware, software. None of this is curated. No one really has a good data management plan, which means that there's all this really value in our society that is actually not extracted, dormant, and like this, our society screams for us to actually get into the digital phase and do this properly.
Mm-hmm. I'm glad you brought that up because actually, a core objective of the new Advanced Research Knowledge Management Division is not only ensuring that we utilize data correctly to inform policy decisions and to drive evidence-based decisions, but also that we ensure that these data inputs are sound and that we have proper governance around our data. So while the industry is using it, the regulator is asking the exact same questions of how to ensure that the data-driven decisions that we have uses data that we can rely on effectively. So let's dig into that a little bit more and kind of guide into some of the questions that you probably want to hear around things like artificial intelligence. So first, I want to direct this question to Mark. So NEO's mission is to reinvent how Canadians spend, save, and grow their money. I know there's a new NEO Invest product that you have. So how is NEO using data and new technologies to improve consumer financial services?
Yeah, so if you think about a lot of tech stacks that financial services companies have, the interesting thing right now is that all but largely one of them, and then there are a couple on the wealth management side, outsource large chunks of their tech stack. So what's that mean from the consumer standpoint? That means that if you want something new, it's on the timeline of the service provider, not your actual partner relationship bank. And that service provider is going to do a one-size-fits-all solution because that's better economies of scale if you're providing enterprise solutions, and they're likely going to do it at a timeline that a lot of people ask for it. One of the things we found in tech and finance is that if you actually want to be super responsive to what your customers want, you have to put your entire tech stack in-house so that it's under your control and you can launch products at your own timeline. And I'll give kind of a very simple example that uses that and then a commercial innovation. If you think about rewards programs on credit cards, very simple, been around forever. A lot of those are also paid for by the fees, by the interchange, by interest, and that's how they're able to offer rewards. One thing we did that was kind of a commercial innovation, and there's a large data component to this, is we went out to thousands and thousands of merchants and got them to pay us directly for rewards. Suddenly, the interesting thing you can do there, given your own tech stack, is you can take a rewards benefit that was only on a credit card, and you can port it over to other products because there is no longer a cost structure there that you need to support with certain types of fees. So we actually moved that whole reward system, and it's available on the secured card, which, just to give background in Canada, if you have bad credit, your options right now are to pay someone for the privilege of reporting credit. One thing we found is that by breaking these two things apart, by using our own tech stack, we can give a free product where people build credit and they access rewards. And as you can expect, the data obligation there is so onerous that you could only do it if you had everything in-house, probably similar to what you see with some of your complex projects.
Mm-hmm. Great. Okay, so let's dig in now directly into artificial intelligence. I'm going to direct this question to Jean-Christophe because this is your area of expertise. So your current work focuses on applied machine learning to understand how the digital world shapes our society. So let's start with some basics. What is artificial intelligence? How might it benefit consumers of financial services?
So everybody hears about artificial intelligence all the time. It's a basic, technology that tries to replicate essentially learning that simulates a little bit what we do as humans. So what we're actually trying to do is build algorithms, models that can replicate, find, regularities and signal in a vast amount of data. A lot of these algorithms were developed in the 19th century, and a lot of the, let's say, pre-neural network artificial intelligence was like old math that you actually learned to do by hand. Now today, today now, I'd say in artificial intelligence, it's applied to different kinds of context. There's different kind of strands of artificial intelligence. I'd say the ones that are most promising are like what we call prediction models. So, for services, for example, how to predict future trends and those kinds of things. In my work, I mostly focus on what we call natural language processing. So how to transform and read and create language. So all of you probably heard about ChatGPT. We've been using that same technology 3, 5, 6 years ago, and we were building these generative AIs for a long time. Now we're at the phase where it's starting to be applied and used in the grander public, but most governments were doing this, and it's going to kind of focus in. And the third one is really computer vision, is really trying to find similarities in pictures and creating pictures and seeing pictures. So when you really think about AI, it's really a complement of different kinds of techniques and ways to extract really signal and information out of large data sets and somehow find these regularities, which allows you to predict things in the future. There's AI everywhere in everything you use. You probably know this in your phone, in your car, in your toothbrush, in your Netflix. We use little bits of AI and trying to kind of predict what kinds of things you would like, and it works pretty well in the grand scheme of things. On financial markets, there's different kinds of applications. My focus is really on information. What I do and what I focus on is trying to extract, understand, narratives and discourse in large amount of information. When I say large amount of information, we were scraping Twitter data during the COVID vaccine. My data set today is 1 billion tweets. So when we talk about large language models, it's really a lot of data and doing this. And what we're trying to do is extract those signals. If you think about financial market, I see this as a function of information and speed. It's not about really money. People are exchanging and investing in information. People with good information and can make decisions rapidly can make a lot of money, and those who don't have access to the asymmetry of information, they do. So basically, the AI can actually build this. If you can build better models to extract a lot of information, identify the signals in the noise, and be able to make decisions on those information, then you're able to really extract a lot of value out of what you're doing.
Mm-hmm. Did you have any other?
One thing I think is kind of interesting when you have a data advantage or you have an AI advantage in the financial markets is you end up with two types of companies, and it kind of stops and starts progress. So you either end up with super quiet companies or super loud companies. The super quiet ones are the ones where you can never figure out how they make money, and they never tell you, but they've been around for 40 years. They usually have some type of sustainable data advantage, and I can think of a number of funds like this where they keep adding those tools that you just described, and they are insanely quiet about it. The other ones develop a data advantage, and they go out and they talk about that data advantage because they want to raise a lot of money on it to exploit that market. And I think this kind of creates an interesting thing where anyone here who's been at those businesses where you raise a ton of money, the complexity there is it is difficult to deploy a significant amount of money without taking some sort of levered rate bet is what the derivative of your bet ends up being. And so you see these companies where they're actually super smart people, they have some sort of data advantage, maybe it's housing, what cars should be priced, but they end up having to deploy enough capital that's just a levered rate bet and they blow up. So you kind of have this interesting part of the market where the quiet ones keep advancing it, and these loud, noisy ones kind of stop and start a lot of the progress, and you don't see a lot of the ones in between that develop a data advantage that we get a lot of visibility into.
Great. So in our division right now, we're assessing the use of AI and the use of data in terms of how it can augment the regulatory functions that the ASC engages in, so how we use it. We're also assessing how registrants are using it, and whether or not the use of artificial intelligence technologies could lead to things like predictive biases or have a disparate impact, a negative impact on certain stakeholders in the capital markets. We're also looking at it in terms of how bad actors can use it for, quote, nefarious purposes, or to the things that we talked about in that title slide that we showed on the last panel. So I want to direct our conversation around AI now to that part. So what are some of the risks and challenges that, and I'll put this to both of you, what are some of the risks and challenges that you see and some of the dangers that you see in not just AI technologies, but big data and data capabilities deployed into capital markets?
I think one interesting one is that AI can create a lot of noise, almost infinite noise. You can create all the content in the world with AI as quickly as you want. And a lot of what everyone here knows and what you tell your clients and what's accurate is that a lot of investing is simply tuning out that noise. So suddenly that job is made more difficult because you've got infinite types of analysis on companies and some of it isn't even accurate, but it's out there. So I think that's one extremely dangerous thing. And then I think the other thing is that AI for a lot of data-heavy industries can allow you to make decisions extremely quickly. And there's a part of financial services where slowness is a feature, not a bug. You don't want people to make decisions exceptionally quickly. That's one of the reasons that housing has actually been an okay return for people, is because they can't suddenly sell their house like that at the bottom, and that's good for them. But you suddenly see AI as it facilitates a lot of industries where, okay, I'm going to give you a tool that's going to allow you to trade in and out of that, and it's going to tell you what to do every second. For some people, that's useful. For a lot of us, it's probably dangerous.
Any other
Yeah, there's a lot of challenge. So when you think of data analytics, I see this as a core function of like four things. There's data collection, data management, data analytics, and data visualization. And everyone that is worth their salt in data analytics will tell you that this is how they think about projects. If you think of the risk, there's risks at all of these steps. Yeah. And sometimes some companies are really good at data collection and they're really not good at other parts. So in the data collection part, the issue are all around. There's privacy issue, there's security issues. As you're collecting data, then other people will start to like cyber attack you and get that data out. And we've seen a lot of companies fumble with those issues of protecting privacies, protecting the data they have, and being able to do this. Slowly but surely, we're going to regulate those in ways that will probably have complexities for companies like yours, and that's going to be interesting. And the data management part, it's also an issue as all these companies have all these legacy data sets all across the world, and not a lot of them are well managed, they're not well stored, they probably are hanging around in things, and that's going to be really difficult for companies to actually manage. In the data analytics part, in AI, we know now that there's a lot of issues with the use of AI. There's different kinds of AI models, but I'd say like the most use is usually what we call supervised machine learning, which is where you actually train an algorithm to replicate some form of classification that you're doing. So for example, in my work, we have a way to measure anxiety on social media. So what we've done is essentially we've created a data set where we tell a tweet, is that anxious, is that anxiety or not? And yes, no, and then you create that data set on scale. And then we create a model to kind of be able to classify in the future. What we know is that by training these data sets, you imply a lot of the biases that you have in your society. And a lot of those training models sometimes will replicate racism, sexism, and all the kinds of bad things that we're seeing in our data sets. At one point, ChatGPT, people were like, hey, ChatGPT could say racist things. Well, it's trained on trillions of pages of internet. So if the internet finds that, then it's going to replicate this. And finally, in the data visualization part, that data doesn't mean anything unless you're able to transform it to something. I see this as like a tertiary sector where you transform the data into something that is value. And here, I think we fail often to be able to do this, to help talk about data literacy and everything. So there's risk at all points. I would like to reiterate the information part. At this point now, we are in an information world where I could actually probably create, and automate millions of information on any companies nefariously, put it online, and create a full information operation to crash a stock or raise one. And it's not very complicated. And countries are doing this in foreign interference, in Canada, abroad, and we can automate it and do it. And generative AI, like ChatGPT, will make this more and more difficult. I actually don't know how you get out of this capacity to create a lot of noise, a lot of impact, and this is where the slowness comes in. But I think there's a danger here where, in some respect, I see this as the same as cybersecurity. For a long time, companies didn't take cybersecurity seriously, and some still don't. And then at one point, they get burned. We're going to start to see this in the information space. If I wanted to invest, I would start to say, like, how's your comms team? And how many people do you have? And how do you risk manage this thing? And how do you know that what people are saying? And do you have like an analytics function that tells what, like brand watch and tells me exactly what you're doing? And if as an industry you don't have that, that's going to have an adverse effect on the impact. A good example of this, big pharma. They're producing vaccines across the world. For a long time, Merck, Pfizer would do nothing on anti-vaccine misinformation, and in some respect, that actually had an adverse impact on their capacity to sell vaccines. In Ireland, they did a study where they found that vaccination for HPV dropped by 50% just because of one anti-vaccine campaign. If you're a big company that tries to make money off of selling vaccines, that actually affects your bottom line. And to be honest, these companies had no answers how to fight anti-vaccine narratives, and they still don't, if you really think about this. So the risks are there, and it's going to compound with capacity to create images, create a lot of noise, and it's going to be very difficult for stockbrokers or markets to actually get a sense of what's happening and what is real and what is not.
Yeah. So let's take that even a little bit deeper, too, and I'm going to direct a question to you, Mark, but Jean-Christophe, feel free to opine on it as well. And I want to take up, so you talked about this idea of slowness. Well, that's not what we're seeing with the trends. We're seeing significant trends of do-it-yourself investing, order execution only platforms. We see the ability to interface markets then has a catalyst of social media activity which can spur quick behavior, not slow behavior. It's not easy to get advice. You got to pay for advice. And so what do you think about when you're thinking about kind of this evolution of the market towards speed, interaction, acceleration, catalyzed herds, things like you mentioned big pharma. November 2022, there's a fake tweet with Eli Lilly saying all insulin is free, and we see a 4% spike in the trade. So things happen instantly. So as an industry participant, what do you think about in terms of this evolved market?
Yeah, this is super interesting right now because it probably was a factor in some of the bank runs you saw at the start of the year is the switching costs are extremely low. And the wild thing is they are continuing on that trend, if not accelerating. And so you think about, okay, if you're a regulator or you run one of these institutions, pretty much the only way other than trying to halt that trend, which is very difficult, countries have tried to halt the trend of technology, it never goes well. So if you think about it, really your only option is to give the customer something that is stickier than what they've historically used as their North Star for whether they should be with that institution. So I think what you'll see, for example, let's take savings accounts, so deposit balances. The North Star was what rate am I getting from my institution? It is very difficult in a lot of countries to very quickly change that rate and instantly switch. That's kind of crazy when you think about that in terms of, hey, how sticky are your deposits if someone can press a button in an open banking environment and move them there? That's probably pretty dangerous, and that's probably why regulators move slowly. That's scary to them. So what you're going to see is institutions are going to start attaching things to that service that are different than what they did historically. So you will compete on features again. You will compete on complementary products again. And I think largely for the consumer, and this is why you see advocacy groups, this will be better because your institution will be saying, okay, I know whenever I had to get deposits, I'd go to the broker board or I'd toggle that rate and I'd get all these deposits, and I know that you guys were pretty lazy and you wouldn't switch for 2 years, 3 years, and I felt pretty secure when I was doing my modeling. That's no longer an option, so now you have to really go and say, okay, why is that customer with me and what do they need? And I'm going to make sure that I either offer those services in a unique way or I'm going to build out the capabilities to do that. And long term, that will be better for the consumer. But there's definitely going to be a scary period here. And you even saw some people testify, like at the start of the year, that was a cause of some of the bank runs because it's too easy to switch. And yeah, if you can get money market funds instantly, that's very appealing to people. So it has to be navigated carefully.
I mean, so my sense in the regulation part is that in the grand scheme of things, institutions are slower than tech companies. And I find that we're always at the back end of trying to solve last year's problem. We're still in this country, for example, still messing around on platform regulations. We actually don't know what to do with it. And in some respect, I see the security regulations to be the same way, where chasing always the next technology will become a never-ending enterprise. I don't think you can get away.
We don't have enough resources to be able to do that.
No.
Speed, yeah.
I know. My sense is that that's going to be the main challenge of regulation, is that trying to get those groups of people who kind of understand these things. So in the information space, for example, we're seeing now more and more customers, information users moving from platform to platform. So for example, you've heard that the big platforms cut off their access to news media recently. You asked me that question, right? And what we are seeing in the data is what? On the one hand, people are going back to actual legacy media. They're going back on these websites to grab their information. And they're also using information differently. So when we do polling, for example, the largest media organization growth in Canada is YouTube. Younger people now take their information from YouTube more so than anywhere else in the information space. But that tells you that it's going to move ever again. Twitter was a thing 2 years ago. It's not anymore. Now we're scraping, Telegram, and then we're moving from platform. As a regulator, that becomes very onerous and difficult to kind of stay on top of things, because by the time the system kind of adapts to new technologies and new challenges, then it's already behind and chasing something else.
So one of the things that I think gives me hope as a regulator is that people continue to use intermediaries. I was in the blockchain space in 2015, 2016, and there was talk about complete disintermediation. By this time, we wouldn't have any banks, and we wouldn't have any investment dealers, and none of it would exist. Well, that's not been the case at all. People like using intermediaries, and I think that gives us, hope and a sense of the ability to create informed regulatory frameworks around intermediaries. And so, as we look as regulators to the future, looking at these fast-changing, evolving technologies that are hard to keep up with, but mindful of the fact that people still use intermediaries, and maybe, as you're saying, increasingly so, because in order to have a function of trust, we have to utilize that. What are some things that you would tell us? Like, what would you inform us to stay aware, or how to interface and engage with new technology?
Yeah, that's a good question. So I think the thing that you have to keep in mind is the trade-off between speed and kind of that customer-centric focus and the risk associated with it. And I'll give one example that I think is going to be one of those things where you're starting to see it, and once it's out, it's going to be very difficult to kind of put the genie back in the bottle, and that's effectively decentralized finance of all assets. If you think about what the financial community loves to do, it's like every great innovation is largely just syndication for kind of the past 3 decades. And you are eventually going to see this with all assets. And I think that will be great in some ways for the average person. You've got a lot of assets that are only available to certain asset classes. Like outside some types of crypto, art has been the best asset class return for several decades. But a lot of people can't afford those pieces. So like decentralized finance, blockchain, these technologies allow people to get access to those tools. Now, I think the danger is that anytime you have opened up an asset class to a lot of people, historically what you see is the price inevitably climbs because the market for it is larger. So suddenly, for the house in my neighborhood, I'm no longer competing with Joe down the street. I'm competing with everyone with money globally. And I think that's kind of the thing, as I think about blockchain, you can get into a lot of kind of, arguments on should this be allowed, and even it goes tangential, like is this a security, how should I treat this? But I think the real thing for consumers is in the next several years, you are going to open up all asset classes to everyone, and a lot of people depend on those assets for, shelter or for use. And that becomes kind of a dangerous thing when it's available to everyone, because we've seen with asset classes, like there's volatility you may have to protect the consumer from. There's additional fraud you may have to protect the consumer from. And so you're gonna have to start applying your lens to a bunch of things that you didn't have to before, which is an admirable challenge.
Yeah, you bring up a good point, and I don't want to hear Jean-Christophe on the regulatory kind of point, so I want to come back to that. But just on this point, before we get away from it, it's kind of an irony or a paradox, if you will, that these technologies which are designed to democratize financial services, to make a more inclusive environment, raise asset prices, connect global markets, and maybe lead to more financial exclusion, or have other types of externalities that maybe or unintended consequences that we maybe didn't anticipate, or the white paper didn't tell us about when technology was being deployed. Jean-Christophe, just speaking back to regulators, like what?
So, I mean, I see a lot of, so in that kind of democratization of financial services, right? I see a lot of chaos where you'll have a lot of agents with low-level information making, micro decisions that might have an impact on the grand scheme of things. You see this on social media where, we had this faith that social media would create all this information, people would connect better, and like that would be so cool. But we also found that it actually allows nefarious agents or people to connect also easily and spread this information. Now they're not stuck in their environment. They're able to reach out to other people across the world and create real national or international and global scale. My sense is you'll start to see that also. In some ways, a lot less predictability about the market on like where things should go and how things should go. You'll have bank runs, you'll have different kinds of quirky stuff, and building resiliency in that environment, I actually don't know how you're gonna do this, because then are you gonna protect the customers in India or in the US or in France making, micro financing decisions on a Canadian, like that's gonna be massively complicated in scale. It's also going to be very, very difficult to track, because there's going to be this push toward, data privacy, data access that will impair like your capacity to actually make sense of what is happening. And I see a lot of uncertainty in the future, even for the regulators, kind of making out, where the trends are going, and a lot of things will be chaos. If I would invest in chaos. Some things won't make sense, and you have to build this in your model. So like something will crash for no other reasons that, the audience went there.
Nonlinear reactions.
That's exactly it.
And another function of our division is systemic risk modeling. So we're thinking about nonlinear interconnections and reactions and things like that. But I think it's kind of interesting to contrast that, and maybe it does come back like the kind of opposite of chaos. So we're looking at, the opposite of entropy is having some type of trust and some type of signal that we can point to. And maybe that's the paradox of all this, is that as the chaos emerges, that we will actually be back to more legacy type. People will seek out legacy type frameworks where they can achieve that trust. And, now obviously it impacts price of securities, price of assets, and other types of things. But these are things that I think we have to continually be mindful of. Maybe last, one quick question, then we have a question from the audience and a comment about your enthusiasm. So thank you on the panel. What should we be mindful when we look to deploy technologies internally? So for whether it be for surveillance functions or compliance or oversight, or to augment the type of analytic work that we're doing when we're deploying data and technologies internally, what are some things we should be aware of?
So a couple of things. On the one hand, I think you have to build data analytics groups within your institutions. Every time we work with data people, we find that companies who don't have this capacity in-house have a hard time to adjust to those kinds of things. So you need the capacity to do it yourself. Your biggest challenge will be data literacy, both in the public, trying to convey the decisions you're making based on the prediction models that you're doing. A lot of people will be unconvinced by that. But also your decision makers, a lot of them won't necessarily understand the reasons why you're doing this and why the models are doing. My greatest challenge every day working with government is that I don't have enough partners in government understanding basic functions of data analytics to actually move forwards on projects. We have these super cool models to automate media, analysis, but there's still somebody asking, yes, but we should still read the news and like every night. I'll give you an example. At National Defense, there's actually somebody waking up in the middle of the night reading all news articles related to national defense and does a summary for decision makers in Ottawa to read. You can automate this in 5 seconds. It would take me 30 seconds to actually do it. There's still a deputy minister who wants somebody to read this because that person doesn't necessarily trust the AI, the data, the technology. So in-house, that lack of trust in technology has an impact on you. And that's going to be very difficult to break.
Yeah, the only thing I'd add briefly is I find as you add those systems, if you don't do the data validity part first, you end up with a system that, once it's established, it's much more difficult to audit. And then two, it's just producing unreliable insights for you. And I think that's one thing where financial services are actually kind of wild like this, where you say, oh, how wrong can the data be because it's on the person and they gave it to me? But you would be shocked how often it's wrong, where, okay, and it's everything from, yeah, that person moved to they have a new job to they have an income, family, like it just grows from there. So like when you do set up those systems, as long as you have a continuous way to validate the underlying data, then they're useful. If you don't, it ends up kind of actually sending you in the opposite direction.
Yeah, so like you remember like the data collection, data management, data analysis, data visualization, and always kind of audit all of those all the time. Where are we good or where are we weak? Where can we strengthen our things? And kind of checking your system all the time to make sure that that works. And sometimes we kind of over-focus on the shiny tools and forget the kind of grinding data collection, data cleaning part.
Yeah, but well, I know my staff's going to be happy with your last comments because those are some things that we've implemented that are really important to us, in terms of having data governance frameworks and sound data. We recently published internally a data dictionary to inform staff on that. So these are some things that the ASC is doing directly. So we have a minute and a half left, so I'll throw this out to both of you because you've both, Mark, you work for an AI firm as well. Could you speak to some of the ways that the oil and what are some ways in which oil and gas is not using AI, but should be?
One of the ones that I find it's a huge opportunity is on the emissions side. You could actually use AI way more because like emissions, Canada often gets a bad rap, but then it's very difficult to defend the bad rap because there isn't an audit trail. Because you have all these disparate data points, they're very difficult to validate. AI, like the work you and the team are doing, is a perfect solution for that, where suddenly you can go through and you can plug estimates, you can validate estimates based on different data points, and suddenly Canada can substantiate its solid emissions record. Because right now, the other option would be to do a large industry retrofit, and you do put methane emitters at like measurement devices at site, whether it's sniffers, et cetera. But the CapEx associated with that is large, and the data might still be wrong. So I'd say emissions.
I'd say information. For a long time, the oil and gas industry kind of forgot to actually play the long game and engage with the public. There's a lot of misinformation on the industry. There's a lot of misunderstanding on the industry. It's a comms game more so than an actual technology game. And there's ways that could be done that would fasten this.
Right. Well, thank you both. This has been engaging, entertaining, informing. Thank you for joining us today, and hopefully you felt the same way. So let's give these panelists a round of applause.
What a great way to close out. I'm up here to really wrap up the formal program and really to lead you all into our reception. However, before I do, I'd just like to take a few minutes to thank you for attending today. I hope you found the sessions interesting and informative, and you had an opportunity to connect with others. I'd also like to thank our moderators and panelists for being willing to join us today to share their insight, perspective, and experience, and particularly for those of our friends who've traveled from away. We really do appreciate your being with us here in person. It's been terrific. In honor of your contributions, we will be making a donation in your name to the United Way of Calgary and area. And finally, I'd like to thank our event team and the Big Four Roadhouse team. You did a wonderful job keeping us really well-fed and on track. As Samir mentioned this morning, ASC Connect is our opportunity to facilitate a conversation about economic growth, innovation, and intelligent regulation in Alberta's capital market. On that journey, we heard from esteemed colleagues, leaders, and industry experts, and I believe we have benefited from their valuable insights. We've talked about the emphasis and the importance we place on harmonizing regulation across Canada, and you likely learned more about the current priorities of the new Canadian Investment Regulatory Organization, or CIRO. We learned about the importance of collaboration and continuing to push forward on all the critical work underway in our energy industry. There's so much opportunity to work with all stakeholders to leverage the skills and experience right here in our province and across the country. It was an honor and a pleasure to have Minister of Finance Nate Horner and Deborah Yedlin, CEO of the Calgary Chamber of Commerce, speak to us today. Sustainability disclosure is top of mind for many of us, and we were fortunate to have key experts discuss climate-related disclosure standards and expectations. I hope you found it informative to have several senior ASC leaders provide an update on what we are thinking about, paying attention to, and focused on delivering. And to finish the day, we learned a great deal about technology and innovation in our capital market. This event reflects our commitment to sharing relevant information that can support growth in Alberta's market. And it's also our opportunity to engage with you, our stakeholders. We enjoy connecting with our market community at events like today and on less formal basis as well. Your insights help us remain a practical, intelligent regulator. If you have questions or input, we encourage you to please keep an open dialogue with us. Thanks so much for coming.